Welcome to all. Let's start with previous week escalation with respect to what's happening with the announcement about the tariff. So that created some artificial bear market. That's what it has been looked at it currently, because this is nothing induced by real economic degradation by any numbers, by any of the financial institutions or a company's balance sheet, or nowhere this recession has been as a business cycle it created. The fall happened is around 20 percentage close by US market, and then who are interested in India market. What I have done it here is I taken a key index here to explain where we are now, and still we are not see any panic mode yet, because if you can, there are three index that you reason anytime you look at it in US market. One is the Dow Jones industrial average, which is a very old one, which is a bunch of industrial stocks combined, and then their stock prices were uh, tracked as an index. That's a Dow Jones Industrial Average, US big names. And then the Nasdaq 100 index is for the US tech companies, which is like secular growth, and the mega cap stocks like Magnificent Seven stocks and very innovative stocks comes under this Nasdaq 100 index. And then the S&P 500, most of you might have heard this word already. So this is a Fortune 500 companies, which is a large cap index, which is listed in the US market. So if you can look at these three charts for the last 20 years or 20 years, you would get an idea what you, as I explained earlier, the bottom you see the volume, and this each candle is basically a 1 month. Okay, so in 9 to 10 there are 12 months, so you can see 12 candles. So each candle represents 1 month data. What you see here, the year from 2005 to 2025, the red line is a moving average. Okay, 200-month moving average. This is a 50-month moving average. It's nothing but you take last 200 month and then divide it by 200, and then plot that in an x y graph, so that you will get a nice line like this. Okay, so that's a 200-day month moving average, and this is a 50-month moving average. So this is a lagging indicator. Okay, this is not a leading indicator. We know the difference between the lagging and leading. Lagging is something data collected from the past, whatever it has happened yesterday or a week back, month back, or a 10 years back. So based on that, you compute something and then plot that into a graph to take some decision. So that's a one such indicator is the moving averages. It is widely used to know what's happening, to understand the bigger picture. For example, in Dow Jones Industrial Average, touch this 200-month moving average whenever there is a big bear market, we talk about it. So this is started in, you see here, there is a big downfall. Market down happened in 2008 and 2009. Everybody might have aware of it, because this was the great recession happened due to financial institution collapse in US, because of that Lehman Brothers, and everybody was got into the mortgage related problem, and so that was created a recession. Even that recession started almost like a December or end of December 2007, and then it came out of the recession somewhere around Jan or mid of April or 2009. It started going up really. So this is almost like a 1.5 year the market went down. Officially, market is called as a bear market when from the highest price to touch that 20 percentage below. Then you can see next big recession or whatever that we are talking about happened in the COVID time frame. See, the difference between the COVID and then this one is it's a very short-lived, like within 2 months, 2.5 months, the recession happened, and then it is also bounced back. But in this case, you can see 1, 2, 3, 4, 5, somewhere around more than 18 months the recession to reach its bottom and then start up next. So this is what the advantage of looking at the longer time frame. When you are looking at a chart, any chart, not just an index, any company chart also you look at, and you will get a complete picture what is really happening in the market right now. You see, when this has happened for 18, 19 months, then market went up for continuously another 10, 15 months, then had a correction of 1 or 2 months. But let's come to now 2023. There was another touch to the 20 percentage. So this is another close to the bear market, but it is not bear market happened. Exactly it touched 20 percentage and gone up. Here you can see this was 35 percentage this COVID time frame. But where we are now, we are not even that close, but people were so much making a noise and everybody is afraid about this. We are just 10, 12 or 18 percentage or something only down. Okay, so but the worst had happened in 2009. It touched this 200-day month moving average. But the last time, the 2020 also not touched this mode, 200 month moving average. Now we are not even touching the 50. It is very common that this will touch here and then go back, because this lines, right? This is always a support. Whenever you see it touches here and then goes up, it touches here and then goes up, touches here and then goes up. Here it touches and then goes up. Only in this last 20 years, only one time it touched 200 month moving average. So this is how we have to first understand that, like bigger picture is very much important for us at index level. At across various companies, their prices were tracked and then put together as a bunch of into an create an index, and then that index shows us we are still in the very early stage of a market slowdown. It is nothing really we reach to a stage where we need to really worry about it in terms of our losses at this moment. Obviously, what is expected is during all this tariff announcement, what's going on, it's a negotiation tactic to play with different countries to make their trade adjustments. So, but the market, as we discussed already, it is always prices in about the future. So what every investor thinks, it's better to take certain profit and wait outside and see, instead of burning out all the cash. So they're booking some profit and then they will wait and enter back again to the market. So it is not that whatever you see the media, news channel or anywhere, the panics that they're creating, it's just to create a panic so that the normal weak hands like you and me, retailers, will sell to the strong hands. I was keep repeating this weak hands and strong hands statement every time. So, but you no need to worry about it. You assume yourself you are one of the strong hands, and you always travel with these big investors. That's what we are. Our idea here is we have to think like a big investors. So to achieve that, first we should know the context where we are. So very simple. Take this very long 20 years of a chart and look at where we are now in the price action. We are just you know very early stage of market down. It is nothing to panic. This is a one index, okay, in terms of industrial average. Now let's go to the Nasdaq innovation. That's also last 2 months, nothing much happened. Like it may go down another one big candle here and then it come back. Even when we discuss in future classes, exactly we can keep reviewing this chart, and then you see the price actions and then the volume happening there. And this is a 500 S&P 500 that also not even touched that 50 moving average. So let's go to an Indian side of it. India, people were interested. So let me take it to India week. Okay, in India, we have a two important Sensex and Nifty 50. So I took the Sensex and Nifty 50. So we were had the similar issue, like mostly US and India is closely in terms of the trade and other stuff. What happens in US market will reflected in India as well. The similar thing happened in the beginning of 2018, that financial recession. India also gone through the same. Then again, you have this March 2020 COVID timeframe crash. 2023 didn't much affected us, and this is what happened now. Even before Trump elected and become a president itself, much before 3 months before, 3 4 months before itself, India started going down. Foreign institutional investors are withdrawing money, and then various other reasons. But still, Indian market is not so bad. It just very recently only nearing to the 50 moving average. It's still at the very, not even it really gone so low. I think we have to wait and see when is the right time to enter into the market to do the investment. Now it just a downtrend started, completion stage, and then accumulation going to happen. That you can see it in weekly and daily time frame. This is a monthly time frame. I'm showing it for a 20 years. Then what is this Nifty 50? Also, we are just nearer to 50. Okay, you want to get an idea where we are in terms of at a high level, macro level, what is happening at the economic and then stock. You see the news says that India is in a recession and the US is getting into the recession. But when you come and see the chart, there is always like the difference, right? So where at what time the real recession started and where is the real stock market showing the direction, there is always an offset. That kind of an understanding you have to bring in. The price in happening now, it is not actually the real recession started. That real recession to happen, this tariff and all has to come into effect from April 9th only. India is really getting into that 26% of tariff, and then after that you have to see a couple of quarters which companies like automobile companies getting affected, that is getting exported from India. That's where that company's balance sheet on their next quarterly earning release, you will see that how much they lost that revenue, or how much is the problem they have it with respect to their growth and other stuff. Now, market will not wait for all that to happen. Market will adjust today itself. The moment you know the news, whoever holding that automobile related auto parts exports companies, like there are many auto parts companies who export into US. So those company people who are investors holding the stock, they will simply understanding this the problem that would create for them if they hold the stock, they will go and de-risk themselves by selling into the market. So always that they will not wait until the real company comes and says that, okay, I now my business is affected after 9 months later. Now itself price will be get corrected. That is how all the business and every news, the market is always prices in. That's the offset that we were discussed in economic cycle versus the stock market cycle. Stock market cycle always ahead of real economic cycle. Whatever economy will go through will only happen later. But the stock market will already understand what's going to happen to economy, and then they do all the price adjustment according to that particular stock or the index they are holding it. So for a retailer, for us, we don't understand this. We will end up with doing something wrong during this time frame. That's why many of us will have a trouble to understand. I do have a real good earnings from this company, but still the company stock goes down. We don't understand why that is happening, because the adjustments are already happened 6 or 9 months back about that company's growth and then the other stuffs. Let's move back to US stocks and then again talk about. I shown you monthly. Now let's see the weekly part of US stock. The same industrial average and Nasdaq 100 and large cap index. What you see here is the timeline now is in a weekly chart. Weekly chart also, when this is only 5 year I taken it. This is to get into closer what's happening for the last 5 years, and so that I reduce my timeline from month to in terms of the weekly, I'll get a more clarity in terms of what I can see volume analysis, price action analysis would help me when I'm doing it weekly. Also, if I want to go very close to the timelines, I can reduce from weekly to daily, again daily to hourly. What kind of a trading or investment you are doing it, you have to play with this the timing that you selected. Based on that, the candle duration will change for a week or a daily or a hourly basis. Industrial average started for the this started here the real bear market. First leg it gone for 5 weeks, then 3 weeks it's gone up, and then 2 weeks it was just an indecisive, and then again around 7 weeks it's gone down. So, but basically around more than some 8 or 12 weeks, this market is in the kind of a down mode. But what is you can see here is the volume is going up. So that means this downtrend is supported by the volume. If you see in the other discussion that if you remember it, I was talking about these concepts, right? There is a different type of price action analysis we do it, individual candlestick analysis, subsequent the shift analysis, and price movement analysis. So this is exactly like a one single swing. We are talking about the price movement analysis. Your trend should support with your volume. So that's happening now. The downtrend is supported with volume. This gives the idea that this downtrend seems to be harmony with the price action. When it is a harmony, idea is this will be going to continue. The downtrend is expected to further continue when there is a support from the volume. If this downtrend is happening without volume going in the reverse order, like if the volume is going down like this, that is a divergence. That's when you should not believe this trend. Now you should trust this trend because it's supported by volume. Okay, so that's a key takeaway. And the next one you can see here. We are not into really touching here also. In the last monthly chart, you would have been seeing that it is touched only the 50 moving average. Now you can see that it is really, when you're going closer to that, it is touching 200 moving averages. So why I'm giving this is basically the support area where the prices will bounce back. Most of the time it will touch and then bounce back. Okay, so this is where you see the real panic is with we don't people news channel creates. This is the real panic you see here. It went from here to just 2 days. It's shown here is like a real 90-degree fall. This will make anybody will really fear about this market. We don't know, but when you go back and look at to monthly candle and weekly candle, it's not really that to be panicked. It just not even touched 50 average in a monthly and not even touched 200 in weekly. But in a daily, the granularity is so close to a regular tracking of a daily, so it shows like a very big fall in the price. But it is not. It touched its even the major supports yet. So that's the clarity that you should get. Not a panic mode yet. It's not yet reached to the panic mode. As retailers, we should understand the market context to become profitable and increases the percentage of chances to be successful in the market. Keep watching my videos and supports the channel by subscribing it. Please leave your feedback by like or dislike and with a comment. Thank you, and let's be connected in future videos.